Hey guys, Barry Page here with Legacy Money, where the mission is simple to help you take control of your finances so you can enjoy financial independence. In today's video, I'm going to answer your frequently asked questions about the infinite banking concept. Before we get started, I want to remind you if you do have further questions, just leave them in the comments section below and we'll be sure to get to them in our next question and answer session. So let's get started. My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Okay, so we're going to get started with an easy one, probably the most common question. What is the infinite banking concept? Well, the infinite banking concept is not a bank. It's a process. It's really just a thought process that allows, on the you and me level, as Nelson Nash used to refer to it, control the banking function in our life. Well, how does it work? Well, it works through a custom-designed, dividend-paying, participating whole life insurance from a mutual company. There's a lot of factors that play into it, but in the most simplistic terms, that's what it is. It's just a way for us to control the banking function in our lives. All right, another question that comes up once people understand that we're using life insurance, everyone always wants to make comparisons. So here's a question. Which are the best insurance companies to use for infinite banking? Well, obviously if you ask any life insurance company who is the best, they're all going to say they are the best. But infinite banking, IBC, as it's referred to, works through, again, a custom-designed policy. So it's really more about how the policy is designed, but these are through mutual life insurance companies, which that is the factor, that is the important component, because it works best with participating whole life, which are only sold through mutual life insurance companies. So really what's important about the question is the agent, the representative. And so, working with an independent agent that might not be partial to a particular company is probably the best way to answer that question. So you have options. And but some companies definitely work better than others. And there's really only a handful of companies that will embrace, let's say, the infinite banking concept. So out of the thousands of life insurance companies, really only a handful work best with infinite banking. So a mutual company and with an agent that preferably is an infinite banking IBC practitioner, which you can find on the infinitebanking.org website. Okay. What are dividends and paid-up additions, and how do they work? All right, so dividends are excesses or surpluses of capital. And because they're considered a return of premium, it's not considered a taxable event according to current IRS rules. So policies have guaranteed growth even without dividends. And when dividends are paid to the policy owners, they have the option of having them, for lack of a better term, reinvested back into the policy. So they're paid up additional insurance, PUAs for short. Now, every company has a little different name for these. But again, dividends are paid to policy owners, and they're paid by mutual companies. They are not guaranteed. However, the companies that we work with have all been paying dividends for 100 years or more. So it's a pretty good track record, and they're based on mortality and operating expenses and a lot of variables that go into that. But once a dividend is declared, you cannot lose the dividend. It is a part of the policy. So now the policy has continued to grow through that reinvestment into paid up additional insurance. What is cash value and how can I increase cash value? Well, properly designed IBC policies typically have a PUA rider, going back to the other question about paid up additional insurance. And so traditionally, whole life insurance policies don't have a lot of cash value in the early years. As the policy grows over years, that cash value increases. However, if you'd like more growth in the early years, a paid up additional insurance rider, PUA, with most carriers, some carriers have different names for it, but you can add this rider onto a policy to accentuate the growth. Now, this all depends on the age of the client, your desires and needs. It's not always required. Again, if you don't need access to capital in the early years, this rider can sometimes cause confusion, but this can be added to a policy. Most policies, I should say, not all policies offer a PUA rider, but some do. As long as you qualify through underwriting, you can use this rider to accelerate the cash value growth in the early years. What is a MEC? Well, MEC stands for Modified Endowment Contract. And by law, the Internal Revenue Service limits the amount of cash that can be paid into a life insurance policy. A MEC does require attention by the agent and the insured or policy owner, so you do not cross this line. It's not the end of the world if you do. It just means that now the policy will be taxed as normal, similar to any other qualified IRS plan. The MEC really only comes into effect when you do add the PUA rider, or you've made material changes to the policy after issue. And so if you want to take advantage of the tax advantages of a policy, then you want to be careful not to cross this MEC line. Your agent should have more information on helping you avoid this problem. The companies don't want this problem either, so they'll typically send out a letter if you get close to that MEC line. But it's typically because somebody has overfunded a policy through the PUA rider or something they made a material change to the policy. Okay, here's a good one. Why should I borrow my own money? Well, technically, you're not borrowing your money. When somebody has an IBC type policy and they want to make a loan, the policy is used as collateral. So you're actually borrowing money from the insurance company. But this all goes back to the very first rule of IBC, of banking, and this comes directly from Nelson Nash. I'll just read the quote. The very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. So basically, when you save money, hopefully you're getting a return on that money, interest of some type. And so if you spend that money, then that money is no longer available to earn interest. So you give up the ability to earn interest when you pay cash for something. On the other hand, if you use someone else's money, then you will pay interest. So really what is happening when you take a loan against a policy through an insurance carrier, the policy itself, your life, is used as collateral. So in a real simple example, let's say a policy has a $100,000 death benefit and you had $10,000 of cash value available for loan. And so you borrowed against the cash value, against the policy as collateral, that $10,000. Now, you would want to be an honest banker if you're practicing IBC and pay the money back just as you would pay back any other financial institution. So in this case, the $10,000 that you borrowed, if something were to happen to you, if you were to pass unexpectedly, then your beneficiaries, the heirs, if you had a $10,000 outstanding loan, would receive, in this case, if you had the $100,000 death benefit, $90,000, and had any interest accrued, they would also owe the interest. It would just be taken from the death benefit upon your death, and your beneficiaries would get the remainder. So that's how the policy loan actually works. And as far as borrowing, well, why should you borrow from yourself? Well, again, you either earn interest or pay interest. So it's really as simple as that. It doesn't have to be more complicated. The policy is used as collateral, and any outstanding loans would be paid from the death benefit. Can IBC be used during retirement? Absolutely. IBC actually comes alive during retirement. So depending on how long the policy owner has owned the policy and how they have capitalized the policy is going to determine how much can be taken out for income or cash flow during this time. So traditional retirement plans depend on a lot of guesswork. In other words, Monte Carlo simulations and really trying to determine distribution rates, taxes, all of these things. So IBC provides safety and a more predictable tax-advantaged income with less stipulations and worries than traditional IRS type plans. So depending on how someone has treated their policy during their working years, which again, we recommend paying loans back, being an honest banker. But if somebody has capitalized a policy during their working years and now they're in retirement, so the policy is 10, 15, 20, 30 years old, then absolutely it comes alive during retirement. So you can use it to supplement other income if you have other assets, or you can use it completely on its own for income. And this is all determined by how you have capitalized or utilized the policy up until this point. Okay, do I have to repay loans, and what happens if I don't? So we just sort of discussed this. It's recommended if you want to be an IBC practitioner, then yes, you want to repay the loans at least during your working years. A loan uses the death benefit, the policy itself, as collateral. So it does not require repayment. You are in control of the payment schedule. You determine how you'll repay the loan, but interest is charged and is accrued over the period of the loan. So if you do repay the loan, that money is now back in the policy as cash value. The interest goes to the insurance company. As a policy owner, you are a part of this company. That's how dividends are paid. So do you have to repay the loans? No. But if you don't repay the loans, there could be consequences. What's important is that you do pay the premiums. And if you repay the loans during your working years, that is highly recommended. And then later on, possibly during retirement or later on in life, if the policy is capitalized correctly, you may not have to repay the loans. And if you don't pay them again, when you die, upon your death, this will be the loan itself, the principal and the interest will be deducted from the death benefit. Okay, what is a blended policy and how does a blended policy work? All right, so the blend idea is really typically a whole life policy with a term insurance rider built into the policy. You can also purchase term insurance separately, which is sometimes a better idea. It really just depends on the situation. But a blended policy is simply a whole life policy with either a renewable term rider, so annually the term renews, or it could be a 10-year or possibly even a 20-year or longer term rider as a part of the policy. There's advantages and disadvantages. Why would that be used? Well, typically blended policies are used when somebody is really trying to push this MEC limit. So the MEC limit, modified endowment contract, depends on if you're buying more cash value than the death benefit is really what it boils down to. So it's an IRS rule, and so a term rider allows you to have more death benefit. So in turn, you could put more money into a PUA rider, paid up additional rider, allowing for more cash value growth in the early years. So there's pluses and minuses to this, as with everything else. You just have to weigh the options. But the bottom line is it does cause confusion. And so you have to be very careful with the agent and just by paying attention to your statements to make sure you're not crossing this MEC line or making material changes to the policy, which could jeopardize the whole concept. However, it can certainly work. Again, every situation is different. I don't really recommend it on your initial policy, but if you're well versed with IBC, then you could possibly use it later. Again, everybody's goals are different. So if you read Nelson's book, Becoming Your Own Banker, it's all about how you treat the policy. So he recommends capitalizing a policy for 5 years or more. If you don't have the patience to do that, then you might use a term rider in the early years at least to help you build cash value through a PUA rider. So a blended policy is nothing more than a whole life policy and a term policy built together, so they're blended. Okay, what is a 72T? All right, so this just came up this past week with a client I'm working with that's nearing retirement. 72T is an IRS rule, a regulation. It has options. And basically what it allows you to do is to get money from a qualified plan, an IRS qualified plan, meaning an IRA, 401k, or the like, without triggering the 10% penalty. So it's based on mortality, it's based on your age. A lot of variables go into it. Again, it's an IRS rule. It really, has nothing to do with IBC per se. However, sometimes people like to use this rule or regulation to withdraw money from an IRS plan early. It's not something that I practice often, but just depending if somebody is nearing retirement and they don't cross the 72T rule, then it can be used to access capital from a qualified plan without the penalty. Where do I get the money to create my own banking system? How do I get started? All right, so this is a question that most people, when they are learn about IBC Infinite Banking, they want to do it, but the question always comes, well, where do I get the money, or where's the money come from? So this is really what makes most IBC practitioners unique, is that we help people find money, typically that they're losing elsewhere unnecessarily. It could be to taxes, it could be to interest, it could be to fees. But at the end of the day, it's really your decision. If you earn an income, if you have a job, we recommend that you save money. So where are you saving money? Is there a better way, a more efficient way to save money? If you're not saving money, then you should be, if you want to have a future lifestyle. That means your retirement or whatever might be. On the other hand, if you're using infinite banking for financing, Well, you're going to pay someone else to for the use of their money. You're going to pay them interest. So why not save money? And people say, well, why not just pay cash? Well, again, you give up the ability to earn interest if you pay cash. So you're going to have to save money initially anyway. So that's up to you where you come up with the money. We recommend that you save 20% of your income if you want to have a future lifestyle, if you want to retire later. So that's a good place to start. It might not be 20% in the beginning, it could be 10%, it could be 5%. But you have to start somewhere. So it's really up to you. You might have to make some changes, habits, how you spend your money. Your cash flows are what we're discussing here. So we can help you with that. An IBC practitioner can help you maybe find places that you're losing money, and that's really the, the cusp really of what IBC is it helps you to recover the money that you're losing currently to interest, fees, and taxes, and just keep that money in your system, your financial system, your bank. So it really, our process begins with understanding the problems, your cash flow. So we believe that there's more to be had by avoiding losses than by picking winners. So, maybe you're investing or you're saving in some type of vehicle that has or asset that has risk. So we want to reduce risk and therefore use that money, save it in a place that is safe where you cannot lose the money. And, that's where you can get money to fund a policy initially is by just creating efficiencies or eliminating wealth transfers. And there's again, a number of ways we do that. We look at things like your mortgage equity, which earns zero. Maybe you have some term insurance that you're paying too much for. Maybe you're financing, something the wrong way. That's what we're going to look for. We're going to look for inefficiencies and help you recover this normally transferred money. What is the loan rate for borrowing money? Well, as Nelson always said, it's not about the rate, it's about the volume. So every company's a little different, and this can sometimes cause confusion with terms like direct recognition and adjustable loan rates. But at the end of the day, typically the loan rates from a life insurance company are going to be similar or even less in many cases to a bank loan. Now, people hear, mortgage rates these days and car loan rates at 0 or 2% or a mortgage rate at 3 or 4%. And these rates are, as you probably are aware, very low compared to, say, a credit card interest rate or a boat loan or something of that nature. So today, loan rates from life insurance companies vary between, say, 4 and 8%. It just depends on the carrier. It depends on maybe how long the policy has been in force, but somewhere between the 4 and 8% is what a loan rate is. And when it says adjustable, some loan rates, some carriers are fixed rates, some are adjustable. Your agent should really help explain this to you, but it's not something that you want to get too confused with. Just understand that the interest is what is paid to the insurance company. As a policy owner, you take a part in the profits, the dividends paid by the insurance company. And of course, as a policy owner, as a business owner, your goal is to earn a profit. So you want the insurance company to earn a profit through interest, and so it's not a bad thing to pay interest back to the insurance company when you're a policy owner. So the loan rate, again, 4 to 8%, just depends on the company, the carrier, and when the policy loan is taken. How long are premiums payable to the insurance company? Well, like many of these questions, it depends. Everybody's situation is different, so depending on how old the insured is, this might help determine how long a premium payment you want. The longer the time period, the more flexibility. The shorter the time period, the less the flexibility. So in other words, let's just say there was a 10-pay policy. That means premiums are contractually due. They're fixed for 10 years. Typically on a policy like that, you would not be able to add a PUA rider, paid up additional insurance, to a 10-pay policy because you would cross that MEC line. And that's not something that you want to do, but again, it's not necessarily the end of the world. If you do, it's just going to affect the tax treatment of the policy. You might want to just fund a 65 policy for 10 years or a 100 policy for 10 years. So if a PUA rider is used, then you could do that, and then you would still have the option of paying premiums later on down the road. And so when you look at the cash-on-cash return of paying premiums later in life on a policy that's maybe 20, 30 years old, then it's pretty good. So sometimes it makes sense to pay premiums later. Sometimes it doesn't. So it's really just up to the individual. You can sometimes do what's called a reduced paid up policy. It's not always recommended, but again, everybody's situation is different. And that's the point where these policies, they can be built. So they're flexible. So you have options later on down the road. And typically my goal is to help you have options, okay? So you're not fixed into one situation. On the other hand, some people just like that fixed payment schedule, 10 pay, 15 pay, 20 pay. It really depends. Policies, again, are based on your goals, your desires, and they can be built to fit that need. So I always reference Nelson's book when people ask questions, and on page 38 of the 5th edition, he discusses exactly how policies are built. They've changed over the years. There's always new products and ways that the companies are making these policies adapt. But he discusses a single premium policy, which is paid up in 1 year. That's kind of what paid up additional insurance is. And then ordinary life are payable to age 100, which nowadays with the new mortality tables is out to age 121. And then of course you have term insurance. So all of these things determine how long premiums are due or how long you might want to pay premiums. What is the dividend rate per year on a policy? Well, dividends are declared every year by mutual insurance companies on the policy anniversary. Now, the company may declare the dividend at a different time of the year, but each individual policy owner receives their dividend on the policy anniversary, okay? And there is no particular dividend rate. It's based on how well the company performed that year with interest expenses, operating expenses, death claims. All of these things come into play with that. So the longer the policy is in force, the better the dividend will be. And so page 26, again, I always relate back to the book. Page 26 does a pretty good explanation right here with this chart of explaining how banking is a process and how dividends are declared and how they're paid back to the policyholders based on how long they have paid premiums and how long the policy has been in force. When can you access the cash value and what percentage can you access? All right, so cash value accrues as the policy grows. So again, if the policy has a PUA rider on it or it's a shorter limited pay policy, it will have cash value probably in the first year. Now, depending on how you pay premiums, could be monthly, could be quarterly, could be annually, this is the money that is accrued in the policy cash value. So typically what is available is about 95 percent of that cash value. They hold out a little bit just for interest and other things. You could always surrender the policy. That's not recommended. But if you take a loan, you can typically access 90 to 95%, just depending on the carrier, how long the policy's been enforced and whatnot. But you can typically access, most of that money, 95% or more. Now, if the policy's new, then that might take, 60 days, 30 days, again, depending on the carrier, depending on if you're paying annual or monthly. This will vary. But again, this is a question for your agent as you're building your policy and your goals, your desires. Remember, you have to capitalize the policy. And all the examples in this book, Becoming Your Own Banker, show 5 years or more. Again, some people want to access the money sooner, but you do have to accumulate cash value before you can access it for a loan. How do you repay loans? Okay, so loan interest is due annually on the policy anniversary. Loan interest is charged in advance, so let's just say, round numbers, you've got a $100,000 policy loan against a policy, and the interest rate with this particular carrier, let's say, was 5%. So 5% of $100,000 is $5,000. So immediately, the loan now with interest would be $105,000. The interest is not due until the next policy anniversary. So depending on if you took the loan on your policy anniversary or during the course of the year, on your policy anniversary is when the interest is due. If you have sufficient cash value, you could borrow the money for the interest that next year. If not, the interest would be due, and the principal could be paid at any time. But a couple things to remember: if you paid back principal during the year, you only pay principal until the policy anniversary. So this decreases the principal loan. So if that, again, in this example, were $105,000, you had paid back, $80,000 of principal, then that loan interest would be reduced as well. And so then on the policy anniversary, you could just pay the interest, or you could pay some principal as well. Every carrier is a little different, but just understand that the interest is due on the policy anniversary, and all payments during the year go towards principal. It is simple interest, and there's many different ways to actually pay the principal and the interest. You can sometimes do this over the phone. You can do it. Many carriers now have online payment systems, so you could just do an ACH. You might have to set this up in advance through your bank or some type of pre-authorized payment, but you could do that as well. And so that's how you repay the loans. Again, the interest is due on the policy anniversary. Principal can be paid on your schedule during your time frame. Can my parents' policies be used for infinite banking? Well, it really just depends on what type of policy that your parents, might own. So if it's a policy they've owned for a long time, chances are it could be a dividend-paying policy. And so if it has sufficient cash value, then certainly, loans might be available. You would just have to contact the carrier and find out. This should get a statement every year that would more or less outline this. So the cash value that's available would be the amount that typically could be loaned. So every situation is different. Now, if the policy was recently purchased and the parents are over, let's just say, 60 or 70 years old, these types of policies, even though they are often called whole life policies, it could be a final expense or a burial type policy, which isn't really going to accumulate much cash value. So, more information would really be needed to know if you could use these types of policies for banking loans. Why would I want a term policy for infinite banking? Well, you wouldn't necessarily use a term policy for infinite banking. Where the term policy might come into play as I've addressed on another question, is if there's a blended policy, then it might have a term rider. Now, initially, again, when people hear about infinite banking, they want to do it. They might just not have the capital saved to get a policy started. So a term policy could be used in this case. For instance, my very first policy was a term policy with a mutual carrier. And so if the term policy is with a mutual insurance company, typically it can be converted to a whole life policy later on. And there's different factors that determine that, but it could be a 10-year policy, 20-year policy. It could be annual renewable for a certain amount of time that it has this conversion option. Now, why is this conversion option important? Well, let's just say somebody is later in life, maybe they have some health issues or their health changes, then typically these policies, when they're converted, do not require evidence of insurability. Just for instance, this past week, I had a client that had a term policy that was a 10-year term, and it had a conversion option. So they were nearing the 10-year expiration of the conversion. We were able to convert the policy over. And again, that's what I did. My very first policy was a $1 million term policy. The first year, I converted $100,000 to a whole life policy, a banking type policy. So I still had $900,000 of term left, and I had $100,000 at that time of whole life. About 2 years later, I converted $250,000 of that policy, and so then I had $350,000 total of whole life, and I had $650,000 of term still left. Now I still have that $650,000 of term left with a mutual carrier. Unfortunately, it's not convertible anymore, so that conversion, there is an expiration typically on that. But that's why you might use term policies because we want to protect our family, and that's really, at the end of the day, what life insurance is about, is protecting our loved ones in the event that we're not there to care for them so we can replace our income. It's about having a benefit for them. And again, if you want the benefit for you while you're alive, then that policy could be converted without evidence of insurability if it is properly set up, with a mutual carrier. So that's why you might want to own term insurance either as a blended policy to add a PUA rider, or as a separate policy to convert, just so you cover your entire earning capability or capacity, or your human life value, as referred to in life insurance circles. So that's how you could use a term insurance policy. Okay, here's a question that came in about one of our videos. In your video, it indicated that you borrowed against the policy and wrote off the interest as a business expense. Wasn't aware you could do this. Thank you very much. Keep up the good work. Very appreciative, Barry. Well, thank you for the kind words and comments. So this is a question for your CPA, your accountant, your whoever might do your taxes. But typically business expenses are tax deductible. Now, there's a fine line here. You've got to make sure that you dot your I's, cross your T's, and most business owners are looking for tax deductions, but you just have to be careful. So again, this is a question for your accountant, and typically business expenses. So if you borrowed money and you had to pay interest for that borrowed money, that interest is tax deductible. If you're a business, you used this money in your business. So again, ask your accountant, your CPA, and they should be able to provide further explanation of this. Just realize that you have to keep business and personal separate, and that's totally up to you. Sometimes you can muddy the waters. You're already going to have tax advantages, on a whole life IBC policy already. So just be careful that you follow tax guidelines, and always consult with your tax professional. Can I use life insurance in our family trust? Well, uh, this might be an estate planning type scenario. Everybody's situation is different, but the essence of IBC is control. So understand if your life insurance policy is inside of a trust and it's an irrevocable trust, for instance, you don't have access to the policy, the cash values and whatnot. So it really defeats the whole purpose of doing that. Now, wills and trust are a totally separate issue. We recommend that you do have a will. If you have minor children, you might want to have a testamentary trust or whatnot. But this is a question for an attorney. Whoever is doing your estate planning could help you with that. But just understand if you put a policy in a trust, sometimes they're referred to as ILITs, irrevocable life insurance trusts, that you are going to give up control of the policy, which really defeats the whole purpose of using a policy for IBC. There might be other reasons for doing it, but just for IBC purposes, it might not make sense. Should I buy IBC policies on my kids or children first? Well, again, every situation is different. It may be a good idea to own policies on your children, but the parent, if they are the owner, whoever would be paying the premiums, it's important for them to have life insurance first. Most carriers are going to be unwilling to write a policy on a child if the parent is not fully insured, because who's going to pay the premiums? There's certainly advantages to having policies on children. I have policies on my children, but typically at the root of this question is, well, the premiums are less on children than they are on an older person, an adult. Well, of course. And so the goal should not be to minimize the premiums. Once you really understand infinite banking, the goal should be to maximize the premium. So it really depends on the goal. What is the purpose for the policy? It would be the same for the adult as it would be for the child. You really have to examine why you want to do this. Is it to provide, a vehicle for the children to use in the future, maybe to purchase an automobile, to pay for college, different varieties to basically secure their insurability while they're young and healthy. So there's a variety of factors and reasons for doing this, but typically the parent would have to be fully insured before a company would be willing to write insurance on a child or a youth, a juvenile. So one of the rules of IBC, a ladder rule, is teaching stewardship, teaching this to others. So teaching kids financial stewardship and how money works is essential. So the earlier you can start this, the better. Money has to reside somewhere. So if you have extra money to save, then certainly you could buy coverage on the children. I own policies on all my children, and later on down the road, upon your death, if you are fully covered, then where are the children going to put this death benefit? So you want to build a bucket, per se, a place for them as you go through this process. So you might want to own multiple policies. For instance, currently I have 8 policies, and 3 of those are on my children. So later on down the road, when I pass, when they inherit the death benefit, they will have a place to put this capital. But again, this is when you're opening, as Nelson referred to them, as branch banks, and this is, again, part of the whole process. It's not one policy. This can be a number of policies, and so the children would come later, but certainly you can get a policy, an IBC policy on a child. Also, on page 71 of Becoming Your Own Banker, Nelson discusses an even distribution of age classes. So this might help you to understand how you might purchased policies over the years on your children, on your wife, additional policies on yourself when using the banking process. So study page 71, and even distribution of age classes in the 5th edition to learn more about policies on children. Who gets the interest, and why should I pay interest on a policy loan? Well, first of all, the interest is paid to the insurance company, and the PUA rider can allow you to pay additional interest, which Nelson touches on in the book. But something that you might want to, again, I'll always refer to the book, but that is the cost of acquisition on page 70 of, or actually page 68, Becoming Your Own Banker, 5th edition. And this is something that we have to understand. So when you really understand banking and how this process works, the cost of acquisition is very important. But just understand that the interest is paid to the company, and as an owner of the company, you can participate in the dividends, which are declared annually through the policy. And if you want to pay additional interest, this would come through the paid up additional rider, the PUA rider that can be used. So for instance, if the company is charging 5% interest and you wanted to pay back 7 or 10%, if you have the rider on the policy, you could pay this additional interest back into the policy. Okay, so people say, well, where am I going to come up if I'm paying premiums? How can I pay back interest as well? Well, again, you have to capitalize first. And if you borrowed money from a financial institution, a traditional bank, you're going to pay interest to them anyway. So you just follow the same type of payment schedule, and you repay the loan to the insurance company. The principal goes back to your cash value. The interest goes to the company, which again, as a policy owner, you participate in the dividends, and the dividend is declared annually. If you pay extra interest, you could use that to go towards paid up additional insurance, therefore allowing your policy to grow even more. So just understand, when paying interest, what we're discussing here really is the cost of acquisition. And when you control the banking function, you are in control of the money. You don't have to depend, you don't have to qualify for a loan with a traditional bank or financial institution. So you control this, and in essence, there really is no cost of acquisition once a policy has been capitalized correctly. So you're in control of the banking function, and that's really the essence of IBC, is being in control. What is GIO, and why would I want it on IBC? Well, GIO stands for Guaranteed Insurability Option. It could be a different name with different carriers. But typically what this allows you to do is to buy additional insurance in the future without evidence of insurability. We discussed term riders, or having a separate term policy could work similarly. But typically I would use a GIO option on a child if a parent wanted to guarantee their insurability later. So it might be a smaller policy initially on the child. And again, these riders options aren't available with every carrier the same, but let's just say you had a $250,000 policy on a child, and you had a GIO option of another $250,000. So maybe upon your death, they would come into an inheritance, the death benefit from your policy, and now they're looking for a place to put that money. So they might be able to use that GIO option, or perhaps later on down the road they got diabetes, they become uninsurable. That's where that rider or that option would come into play. So it's not necessary, or you don't have to use that rider to practice IBC. This is just an option. Again, every situation is different, and typically I would use that rider on a child or someone that's just trying to guarantee their insurability later if that's uncertain. Okay, I've read Becoming Your Own Banker, Are there any other resources or books that you would suggest for reading? Well, infinitebanking.org, the official website for the Nelson Nash Institute and Infinite Banking, has a book list. But certainly there, and resources actually, videos, if you're an IBC practitioner, if you're working with an IBC practitioner, they should have videos. And I just want to remind you, I have several videos on the infinite banking concept. Just check out my videos on YouTube, Legacy Money, and you'll be able to find out more. But a couple books that come to mind are How Privatized Banking Really Works, which integrates Austrian economics and the infinite banking concept. That's by Carlos Lara and Bob Murphy. So you might want to check that book out. Also, The Case for IBC, which also was co-written by Carlos Lara, Bob Murphy, and Nelson Nash. And of course, Nelson Nash's second book, Building Your Warehouse of Wealth. So this is a great book that really goes into more detail and provides, maybe a different perspective on banking. And Nelson always used to say that wealth has to reside somewhere. So it really goes into that, and then the distribution of this money, this wealth later on in the future. So where you warehouse your wealth is important, and that would be a book I would recommend, Building Your Warehouse of Wealth. So yeah, that hopefully answers your question on further education. Financial education is key when learning about money and how it works, and of course with banking and infinite banking. How do I pay taxes on IBC? Well, that is a question for possibly your tax attorney or accountant, but traditionally, if a policy is set up correctly, you've already paid taxes on your money. Your income was taxed when you were paid. And so money goes into a life insurance contract post-tax, unless you're a business, maybe you have some other scenarios. But traditionally, the policy goes in post-tax. So the money grows tax deferred in the policy and tax-free. It can be accessed as long as the policy is accessed correctly. So there are no taxes due as long as you follow a few guidelines. The death benefit would be payable to the heirs, and typically that is tax-free as well, as long as you do not cross the estate tax guidelines, which today is in the millions. So typically the death benefit is tax-free as well. So as long as you follow a few guidelines, infinite banking offers tremendous tax advantages, and you can access the money tax-free, really tax-exempt. Loans are tax-exempt, and so when making a loan against a policy and repaying the loan, no taxes are due as long as you follow a few guidelines. And again, you're always going to want to consult with your tax professional, accountant, or CPA on these matters. What is a automatic premium loan? Okay, so APL, as it's referred to, automatic premium loan, is a provision that's built into most policies. Sometimes it has to be selected or elected on application, but typically what it is if a policy premium is due, and for some reason the premium wasn't paid, let's just say it's an annual premium, and you were sent a bill, a statement to pay the annual premium, and maybe you were out of town, or who knows where you might be or why the premium wasn't paid. As long as there is sufficient cash value available, then the policy will, what they call APL, automatically premium loan or policy loan to pay that premium that is due. So that's what APL is. It just automatically pays the premium in the event it's not paid out of the policy cash values. You can elect to have this done or not done. It typically would not go into effect until the policy is after 30 days due, and then there's usually another 30-day window in there for that to happen. So it can tie up funds. Recently, I did have a client that happened, and so the funds were actually tied up. He tried to make a loan even though there was sufficient cash value. You just want to make sure that if the policy does that, that you don't need access to the other capital, the other cash value in the policy. But you can just request a loan to pay the premium as well. You typically cannot pay PUA or additional riders with a policy loan or with APL anyway. You could always take a policy loan and use it for whatever. But that's what APL is, just automatic premium loan to pay the premium that would be due, if it were not otherwise paid through the cash value available in the policy at that time. All right, what is backdating and how does it work? All right, so Nelson addresses this briefly in his book, but sometimes backdating may be utilized to basically get a jump start on a policy. Or with life insurance, what they do, the insurance carriers, most of them, and again, every carrier is a little different, but most of them use your closest birthday for your age. So let's say, for instance, your birthday is in January, and now it's September, and you're 50, and on your birthday you're going to be 51. Well, that's your nearest birthday, so your insurance age would be already 51 in this example. So you might want to backdate in that case. Let's just say you're starting a new policy and you wanted to save your age, they call it, at age 50. Well, you could backdate the policy for 6 months, usually, depending on the situation, and that would, up to 6 months. They're only going to go back to your birthday or whatever the nearest time is to help you do that. Now, if you pay annual, then your policy premium will be due on that date, not on your birthday, on the day that the policy was dated, okay? But if you pay monthly, then you would have to pay those back premiums in advance to catch you up to do that. So that's what backdating it is. And so some people like to use it to, accelerate the growth of the policy. So again, if you backdated, then your policy anniversary might come up sooner the next year. And so you could get cash into the policy quicker by backdating sometimes. So just consult with your agent, before doing that, and the company will also offer some guidance to allow you to do that. Can I apply with more than one carrier, and why would I want to do that? Well, typically, somebody might do that if they're in poor health. Maybe one company might underwrite a little differently than another. Maybe it's not poor health, but just had a health issue. So every company is a little different. That's why working with an independent agent might help. So you're not limited to one carrier, one company, but every situation is different. Every carrier has something called reinsurance. So if they didn't want to, underwrite, they might offer it to reinsurance, or maybe just to get a better offer. So again, you'll want to consult with your agent or the carrier on that. And if you're working with an independent agent, you'll have more options. Now, later on, maybe you're applying with another carrier just because you want to not have all your eggs in one basket. Maybe you're opening a branch bank, okay, a separate policy. And so this is maybe your second or third or fourth or on down the road policy. I own policies with multiple carriers. So, you might just want to do that to spread it around. Maybe you had a traditional whole life policy payable to age 100 with one carrier, and maybe your next policy you wanted to be a 10-pay policy or a paid up at 65 policy. So that might be a reason for owning, policies with different carriers, or you might just be comfortable having all your policies with one carrier. But on application, typically, would be, if your health, maybe you smoked or used tobacco, some carriers might offer select tobacco rates, or something different for that. So that or maybe you had diabetes, or whatever the health issue might be. Some carriers might underwrite that a little differently. So that's why you would want to consider applying or having policies with different carriers. Here's a question that I get often. Am I too old to practice infinite banking? Am I too old? So really, age shouldn't be a factor, but if you're over 80, then it's just going to be harder to find a carrier that will issue a policy on you. Otherwise, I have clients in their 60s and 70s, and you can use a policy early as long as you're spending money. Maybe it's on income. You need cash flow. You need access to capital. You want to leave a legacy. With a death benefit, then certainly you could use a policy for that. As far as the banking function, it just depends on if you need access to capital, you need cash flow, you need a place to store your money. As Nelson says, money has to reside somewhere. So it really just depends on your desires, your goals, and what you're determined to do. When's the best time to plant an oak tree? It was 20 years ago. When's the next best time? Today. So it's never too late to get started. You don't have to own the policy on yourself. You could own a policy on a grandchild, on a spouse, on a child. So it's really just up to you. But the sooner you get started, the sooner you'll be able to use the policy, whether it be for banking or other reasons. Okay, so this is a good question to end on because I often get this once people discover infinite banking and how it works. And the question is, why isn't everyone else doing this? And, the answer is really the people that understand it are doing it. Wealthy people have used this concept for centuries. The famous story that I always like to relate to is Walt Disney. When Walt Disney needed access to capital, he was able to borrow against his life insurance policy to start Disneyland. So once people understand it and how it works, they are doing it. Not everybody is suitable for IBC, so it's not everybody. It's not for the masses. It's a different way to look at money, about taking control of your money. And so if your goal is to have a 401k and just save for retirement that way, it might not be the best for you. But if you're looking for an alternative to traditional financial planning, a way that you can be in control of your money and use it for financing, then that's what IBC does. So to give you the opportunity for success, to give you options, then that's why somebody might want to do this. So everybody's not doing it, but the people that understand it are. So infinite banking is a great way to take control of your money and to create generational wealth for your family. Okay, so we're going to wrap things up. I want to thank you for joining me in this video today. And I just want you to remember when considering infinite banking or practicing infinite banking, I always start with why you want to do this. What is the reason? And again, infinite banking is really just about taking control of the banking function in your life. So if you're sick and tired of having to qualify for bank loans, and if you're tired of paying interest to others, then this is just a way for you to recover some of that money and keep that money in the family. So again, ask your questions, leave your comments in the comments section below. Be sure to subscribe to our YouTube channel, Legacy Money, and I'll see you in the next video.